Hey everybody, I hope everyone's doing well and had a good day today. This video is going to be a recap of the Emini 5-minute chart for Wednesday, April 9th, 2025. And because the range was so big, to see the entire day, these are really big bars here. I really have to scrunch the chart up, so I want to look at this as if it's two different days so that we can talk about the price action over here, kind of like this. And before we get into today, I had a thought about the weekly chart, which I might have said before, but it's worth bringing up again. Through here, we have a spike in channel bull trend. And we know 75% of the time, bull channels get bear breakouts and channels evolve into trading ranges. And the market just simply did the higher probability event here. Spike in channel, bull trend. You could say the channel began here. You could even say it began here. We have a spike and a pullback that the low of the pullback was here. So you could say the channel began down there. So what's interesting about the weekly chart is the reaction to the test of this bottom. The market simply tested the start of the channel, which is often support and becomes the bottom of a trading range. And what's interesting to me about it is there's always news that can be credited or blamed for what happens in the market. But if you never knew anything about the news and you just took a price action point of view of this chart, you would say it's a spike in channel bull trend that evolved into a trading range. And yes, it fell in a hurry to test support, but what happened at that support? We bounced. So the point with showing that is all the news and all the information is really baked into the price action. So if you are a price action trader, then the source of information should be the chart in front of you. And it doesn't matter what happened with news reports. It doesn't matter if Trump tweeted anything. It doesn't matter what's happening with the tariffs as far as price action trading goes. That's my point of view anyway, but I've learned that from Al Brooks. Sometimes I show the Globex chart going into the day as we look at the 5-minute, but when there's a small gap, it's safe to assume there's a trading range in the overnight session. So today we'll just get right into it. And because the gap is small, I'm just going to look at the RTH, regular trading hours chart, and not look at Globex chart. But I do think it's a good idea to have an idea, to at least glance at the Globex chart going into the day. Going into the day, and I have a little extra time today. I don't want to do a full bar by bar, but I do want to hide the bars to the right so I can make a few points. This is the way I saw it this morning. I see a bear trend yesterday, climaxes, consecutive sell climaxes, possible bottom, start of a trading range, and then a strong reversal up. So we might be converting into a trading range, but we do have a bear trend line here, and it looks like the market reacted to it on bar 3. Bar 1, bull bar, but big tail. Bar 2, a stronger bull trend bar, breaking out. Good for the bulls, but 2 legs up against a strong trend. And then bar 3, bear, reversal bar, closing on its low, testing that trend line. At least that's one area of resistance that I noticed. So here I'm expecting sellers above, but strong enough rally for a second leg up. Traders are trapped below. So probably buyers below for a second leg, but the second leg or the upside might be limited because of the trend line, which it looks like the market is reacting to. So 3-bar micro channel, 1, 2, and 3. I said strong enough rally for a second leg. First trend line break on 4, probably buyers below, second leg up. 4 is a good buy signal, bull bar closing on its high, probably at least some buyers above. Not ideal to sell directly above 4, but I suspect there are sellers above bar 3. Then you can see testing the trend line once again on bar 6, but another 3-bar micro channel, low 2 short, low 1 below 3, low 2 below 6. Whenever you have a low 2 in this case, and the second entry, the second reversal, in this case bar 6, when the second entry is at a better price, in other words, if you're a bear and you sell below bar 3, or you see the sell below bar 3, low 1, and then you have a better entry, you can sell at a higher price below bar 6, that should raise suspicion, because typically, if you think about it logically, you pay for more information with a worse entry price. But in this case, you have more information and now you can sell at a better price. So suspicious, low 2 below bar 6. But it looks like there's still a reaction on the trend line. So again, upside might be limited. And then 7, bull breakout bar, but big tail, closing above the trend line, good for the bulls. But what's the approach and what's the context? We have 3 legs up. 1, pull back. 2, pull back. 3. The third leg subdivided into 2 legs. 1, pause. 2. And there's a channel line there. You can also draw a channel line like this. 1, 2, 3. The point is that there's a lot of resistance. The bulls are trying to break out of resistance, and the tail on bar 7, not a good sign. Sellers into the close of a bar during a bull breakout. It's a late leg. It's against the trend. Bulls need follow through, and meaning they need another bull close, preferably a bar like bar 7, but closing on its high, maybe somewhere up here. And instead we got bar 8, so a strong bear trend bar. Now this is good for the bears. We've had 3 legs up. We have a bear breakout. It looks like the trend line is holding. 1 close above, but no follow through. So bar 8, probably leg 1 for the bears. Bear breakout, second leg down, likely. In other words, to me, high probability that if you sell the close of 8 and you're willing to scale in, you're going to make money. And I think it's okay to sell the close of 8, but what's a reason why traders might sell a pullback instead? One reason is all the overlap. So we have a lot of overlap with all the bars here. This is not kind of like over here, 15, 16, 17 might be becoming sell the close. There's space between the bars to the left. 38 closing below a lot of bars. Not the same overlap that we have here. And when it's more of a trading range or a channel, traders will enter on pullbacks instead of panicking into selling, or in this case, traders are not desperate to get short, at least not at this point. So what happens on bar 9? The market pulls back, we test the breakout point, the bar 7 low. Why do we test the bar 7 low and find sellers? Well, with everything I've said, the context is pretty good for the bears. 3 legs up to a trend line, bear breakout, closing below the prior bar. And bar 7 is a bad stop order sell signal bar. It's a bull trend bar. The odds are, or the odds were, there would be more buyers below 7. And it's a reasonable thing to do, not a great trade, but to buy below bar 7 and scale in, you'll probably make money. Meaning, even if it goes against you, your entry price will probably get retested. You also have bears, maybe not too eager to sell below bar 7. 4-bar micro channel, bull signal bar, not really ideal. So you have bears who do not sell and bulls who buy, both trapped. Bulls trapped into a losing position on the close of 8. Bears trapped out of a trade that is going in their direction. It's working. So both bulls and bears are trapped, and this creates resistance above the market. Sellers above. Bulls who bought the low of 7, just hoping the market comes back. Think about if you bought the close of 7. Disappointed with your entry bar. The market's closing below your entry price. If you believed the market would be lower, let me put it this way. You would not have bought the low of 7 if you thought the market was going much lower. So if you did buy 7, you're disappointed with bar 8, and you might just want to exit at break even if you get the chance, because the risk at this point, 3 legs up, this might be a trading range. We could easily go down and test the low of yesterday. You also have the low of bar 1. Bar 1 in general remains the low of the day 20% of the time, which means 80% of the time it does not. And 80% of the time there's a trading range open. So is this a bull trend from the open? It might be, but big bear bar closing on its low, big bear bar closing near its low, 3 legs up, testing resistance. Not ideal for a bull trend from the open. There's a real chance we get down below bar 1. That's the risk of staying long up here, and that's the incentive for bears to look to go short. And that's why everybody sells the retest of that breakout point on bar 9. Now this is leg 1, pullback, leg 2, but now a 3-bar micro channel. So is this the second leg for the bears? It is a second leg on a smaller time frame. Like I said, bar 8, pullback to the high of 9, second leg down, 9. But this entire sell-off, the 3-bar sell-off, might be a simple leg, and it's a breakout on a higher time frame, and this entire sell-off might get a second leg of its own. So at this point, probably sellers above 9, bad stop order, buy above 9, bad context to look to buy, and a bad signal bar. So bears attempt at a second leg down, but buyers below 8. Continuing sideways, but still you can see it looks like the trend line is holding up for the bears. 13, bull trend bar, it's a breakout, but context, not ideal. Why is context not ideal? Because the bulls have 3 legs up to a trend line that is holding. Lots of overlap here, tight trading range. Breakout of a tight trading range probably will not go far before we come back down into the range of the trading range. And to me, bars 7 through 9 are probably going to get a second leg better than bar 11. But if this does break out to the upside, we'll look back at this and say the bears got their second leg on bar 11. If you sold the close of 9, got trapped on 10 and 11, 11 gave you a chance to exit at break even at the close of bar 9. But 13, bull bar closing above the bear trend line, just like bar 7 did. We need follow through, and the bulls don't get it. So again, another bull breakout attempt that is followed by a big bear trend bar. 14, you can call it a head and shoulders top, left shoulder, head, right shoulder. And I usually don't use that term, or it's not that I don't use the term, but when the market isn't a bull trend, you're going to see wedge tops and head and shoulders tops all the way up. But the reality in a trend is that reversals fail. Most reversals fail, and they become continuation patterns. But in this context, to me, the market cycle is a trading range. Big down, big up, counting legs, 1, 2, 3, reversal. So this is not a bull trend. And I think there's a reasonable stop order sell below 14. If you're long for any reason, reasonable to exit below 14, and reasonable for bears to go short below 14. This is different. Let me give a trend example right over here. And look at bar 58. Maybe not a great example, but it works. You can say it's a head and shoulders. Bottom, left shoulder, head, right shoulder. But is this a major trend reversal? We talked about it yesterday. This breakout, while it's fairly big, it's not a significant trendline break. It broke the bear trend line, but we never even got bars closing above the moving average here. And it's look at the context compared to today. This is clearly a bear trend. So that's the problem with 58, the head and shoulders bottom and reversal attempt argument. And in this case, we didn't even trigger it. But you can see it became a continuation pattern instead of a reversal pattern. But here, the context is different. Big down, big up, sideways, lots of overlap, reasonable. You can call it a second entry short. And on a smaller time frame, this might be a bull trend. It is a bull channel. I've been counting the 3 legs up here. Trend line break, retest of the trend's extreme, retesting, trying to get back to the close of 7. But 13, not quite getting there and finding sellers, trap traders above, trapped on 8 and 9. So reasonable to sell, probably always in short. And it looks like the bear trend line is holding here. Bear breakout down to 18. Pretty decent bear leg. But what leg is this down to bar 18? Some traders will probably see a late leg, whether it's bar 9, leg 1, pull back, leg 2, and leg 2 subdivided, 1, pull back, 2. Even through here, we went down, pull back, down, pull back, down, bar 18, a much smaller bar than 17, and we're testing support, the low of bar 1. It's another thing when there's a test of obvious stop locations in a trading range, the market often tests them and then reverses. If you're a bull, you're buying. This is the problem with buying bars like 7 or 13. Where do you put your stop? One option might be the bar 1 low, but the trader's equation, 1 times your risk, you're getting bad risk reward, 1-to-1, and the market has to go a far distance, and you don't have the momentum on your side. It's a trading range. So your stop is far, and your probability probably not much better than 50-50. Stops below bar 1, it's an obvious stop location. And the problem with putting a stop here is that if the market comes back down to bar 1, down to the low of bar 1, are you really eager to sell down here? Because if you think about it, if you're a bull putting a stop below bar 1, you're saying if the market goes 1 tick below bar 1, your premise is invalid and you'd rather be selling below bar 1 than buying. But the reality is that it's a trading range. We're getting a vacuum test of support. Bar 1, there's layers of support. Here's one layer. There's more down here, maybe the high of 76. But in any case, the reality is that you'd probably rather be looking to buy here than sell. You're probably not desperate to go short down here. And this might be a second leg trap, strong looking second leg, maybe 1, 2, like I said, subdivided into 2 legs, and then you get 19. Bull bar closing on its high. So might be an always in flip here. Bears, short for any reason, may look to exit above 19. Bulls can buy. The problem is this tight sell-off. 3-bar micro channel, 6 bars down. First reversal is probably going to be minor. At this point, we might have a triangle. We might have a higher low here. We're getting lower highs up here. The market is getting squeezed into a tighter range. As we get more information, we can change the way we draw the trend lines. And you can see market seems to be reacting to this trend line and this trend line. What happens here? 1920, bull breakout and follow through, probably get a second leg up, pause bar, second leg, we test the trend line, bear bar closing on its low, might go back and test the bull trend line now. And that's what we do. We find buyers and the market's getting squeezed into a tighter and tighter range. And this is what trading ranges try to do. We're trying to find the fair price. Maybe just trying to kind of guess what the apex of the triangle is here, the midpoint. If we think about it from this point of view, we couldn't really know this in real time, but when we look back at the apex of the triangle as support and resistance, the market here tries to break out below it, vacuums right back to it, failed breakout above, below, and it goes back and forth, each time coming back. Bull breakout attempt, fails. Bear breakout attempt, fails. Bulls fail, bears fail, back and forth, till eventually one side wins. 33, breakout of the triangle and follow through. Good for the bulls. Probably get at least a second leg up, and this might reset the leg count. 33 closed far above the trend line. We're getting bars closing above the trend line instead of reversing right back down into the range. Reversal attempts by the bears, but fairly weak. No big bear bars. 38 low 2, but doji signal bar at the trading range, probably buyers below. Bulls still likely to get a second leg up. And then 42, this rally might be the second leg for the bulls. As we test higher in the range, we're testing the bar 7 close where traders got trapped before. Probably expect some resistance there and some resistance here at the bar 7 high. 43, big bull bar, but fairly late in a rally. Looking back, you would say the rally began down here on 19. So we're about 20 bars into a rally. We're getting the biggest, strongest looking bull bar in the entire rally. Is this a bull trend or a trading range? And in this case, it doesn't really matter if it was a bull trend or a trading range, because when you get the biggest and strongest looking bull trend bar late in a rally, you know it's either an exhaustion gap or a measuring gap. Traders see bars like 43, and if you're a bull, you bought lower, they'll see it as a gift. Suddenly you have a windfall of profits, and traders will take those profits. So then we get selling on 44. Traders taking their profits. Big up, big down, probably go more sideways here. But still, bears don't have much to be selling. This might be the first trend line break, and it's a good bar, but it's completely within bar 43. And then obviously a surprise here. Huge bull bar, second huge bull bar. Also interesting about these bars, if we measure the low of 46 to the high of 46, place it here on the low of 47, almost an exact leg 1, leg 2 between those two bars. So obviously a big bull surprise. Bulls controlling the market, probably going at least a little bit higher. First reversal attempt will probably be minor, so probably buyers below 48. Just look at bar 48. Do you really want to sell? And if we forget about the size of the bars, which, first of all, don't actually forget about it. If you're trading and your account can only handle a certain position size, you shouldn't mess with that. When the bars are 180 points, even trading 1 micro is a lot of risk. So this is one of those times where it's reasonable to just not trade if your account or you cannot handle the risk emotionally. It's okay to just step back and watch and wait for the volatility to come back down. Also, it was funny, earlier in the day, I was thinking, here's yesterday's high up here, yesterday's low. just based on the price action and where we are in relation to the prior day's high and low, I thought we'd probably test the low of yesterday. And I wasn't sure if I didn't necessarily think we'd break below yesterday's low and form a bear trend, but I thought we'd at least test down here and see what happens. And it's just funny because yesterday's high was so far, and we're getting a lot of trading range price action down here. The low is so much closer, and most bars, breakout bars, only about, maybe 10, 12% of the bars on any given day are inside bars. Inside bars are the only non-breakout bar type. Most bars at least break out one tick above or below the prior bar's range, the prior bar's high or low. So the reason why I'm bringing that up is because most bars break out of the prior bar's high or low. The daily chart is no exception. So I'm expecting a breakout above the high or below the low. And of course, at this point in time, I'm thinking we'll probably go at least one tick below yesterday's low. And then of course, surprise bar 46 changes that, and then we get there in a hurry, quickly getting to yesterday's high. So after this rally, I said the bulls are in control. They'll probably get at least a second leg up, and the first reversal attempt is likely to be minor. Looks like let's see. Market fell one tick below the low of 48, but after the bull breakout more follow through, and a weak sell signal bar, probably buyers below 48, low 2 below 50, but do you really want to sell? Is 50 going to reverse this rally? Probably not. It's a good looking bar, but the context really not so good. The bulls are probably going to get a second leg in some sort of channel in the direction of the breakout. But because we pulled back here, technically the spike ends and the channel begins. So we're in the channel phase at this point. We can see there's a channel line that the market is paying attention to. We break out above 48, reverse down, break out above 50, reverse down. In a channel, bulls buy sell-offs and they take profits at new highs. So the bulls become more efficient. Down here, they're just buying momentum, buying for any reason. But once we get that pullback, bulls will start buying lows and, like I said, taking profits at highs. So you buy here, take profits here. Maybe you buy below 50, or you buy some support level. We're in the buy zone of 49. You buy, maybe you look to take profits above 50. And up here, maybe it's 3 legs up, but it's a tight bull channel. So 3 legs up, yes, but are bears having an easy time or a hard time making money through here? Looks like stop order bears not making money at all. So the first reversal, yes, there's probably going to be a minor reversal after 3 pushes, but the reality, when the channel is tight like this, it's a breakout on a higher time frame, and there's probably buyers below. So the first reversal attempt, or this reversal attempt, is probably minor. Does it look major? Bear bar, bad follow through, bear bar, bad follow through, bear bar, bad follow through, bull trend bar outside up. Support at the moving average. And you can look to the left and find other reasons or other support. Bar 51, bad stop order signal bar. We rally. It was support on bar 53 and 54, acting as support later as well. 67, probably reasonable to buy above 67, maybe 2 or 3 legs down. And at this point, it's probably a trading range or a channel. And if we just draw a parallel from this channel line, bring it down to the 51 low, 66 is a breakout attempt of the bull trend line, but it's a late leg and it got no follow through. And then we get a reversal, bull breakout, follow through, more follow through. Big, small, big, maybe we get a pullback, but probably buyers below. And second leg up, likely, higher prices likely, probably at least test the trend's extreme. And the bears didn't put up much of a fight through here. Pretty strong breakout. Bull bar, pause, bull bar, pause, bull bar to a new high. So probably some resistance up here as well, but same problem as this. You can count 3 legs, but better to use that as maybe profit taking and not a reason to go short. There's really no reason to go short here. And you can see we didn't really reverse much. We paused, but we broke out above. We paused here on 72, broke out, retested the breakout point, got a second leg up, got a small tight trading range into the close. Overall, pretty interesting day. And I want to finish up this video reminding everybody that these recaps, these overviews are kind of like nutritional supplements. And I've said that before. They may be helpful, but they should not be watched to replace the Brooks trading course or doing your own work, just like supplements shouldn't replace real food. So in this analogy, the real food is the Brooks trading course or Al's books. Ali Moin-Afshari has a lot of great material and content. But I hope these videos are helpful. The reality is that I started doing these videos because they help me learn and they force me to sit down and think about a chart and articulate what I see. And it's been almost a year of doing this, and it's still a challenge. It's always going to be a challenge, but it's kind of fun. You can make it kind of like a game. It doesn't have to be hard work and boring work. But the whole point of this is make sure you study the Brooks trading course and then take what you're learning and practice it and do it yourself. Make your own PowerPoint slides. Do a level 2 study with an Excel spreadsheet. Study breakouts, understand breakouts, become a master of breakouts. I think that's what every good price action trader really ends up doing, one way or another. So again, with all that said, if you have not studied the Brooks trading course, if you haven't purchased it, you can find a link to it in the description of the video. You can also find Ali's website there. And yeah, that's going to do it for this one. So thanks everybody for watching, and I hope everyone has a good night.